In this video, we will talk about day 0 cash flow statement and day 0 profit and loss statement. So what is cash flow statement? It is a financial statement that summarizes the movement of cash that come in and go out of the company. Flow statement is divided into three parts. First is cash flow from operations. This tracks the cash movement resulted out of operations. Let's say you sold a product to your customer and the customer pays you money. That is cash inflow. But to sell that product, you would have incurred certain expenses and paid your vendors. That would be the cash outflow. CFO tracks these cash movements. Second part is cash flow from investing, which is nothing but CFI. So let's say for our business, we bought stove and utensils. To buy them, we had paid certain cash. This is cash outflow. Let's say if we sell these assets and we earn some money, that would be cash inflow. The cash flow from investing, that is CFI, tracks such movements. And third is cash flow from financings, that is CFF. So let's say to start the business, you had taken a loan from bank, that is cash inflow in the business. But let's say you wanted to repay the loan, that would be the cash outflow from the business. CFF tracks such movements. Now the net cash flow is nothing but the sum of CFO plus CFI plus CFF. Now let's get back to the business and let's construct our day 0 cash flow statement. If you remember, we had to arrange the capital. We put our own money and we took a loan from the bank. We put 25,000. That is a cash inflow in the business and we will label it under CFF, that is cash flow from financing activities. Similarly, we borrowed loan, that is business borrowed loan of what 25,000 from a bank. That is also cash inflow for the business. Thus, total cash inflow was 50,000 and we will label this as cash flow from financing activities. Please note that the inflow is generally regarded with positive sign and outflow is denoted with negative sign. So this is how our cash flow statement will look like after step 1. For now, we will consider CFO as 0 and CFI as 0. Bank loan will be 25,000, owner's money, that's your money, will be 25,000. Thus total CFF is 50,000 and net cash flow, that is 0 plus 0 plus 50,000 is 50,000. Now let's move to the step 2. We made certain purchases. We bought stove for 20,000, we bought utensils for 10,000, we bought ingredients for 5,000. Thus we had a total outflow of 35,000. The stove and the utensils, these are like long-term assets and we had invested money in the long-term assets. So this will fall under CFI, and since we had to pay cash, as in the cash went out of the business, it will be cash outflow. Similarly, we purchased ingredients worth 5,000 rupees. Now these ingredients will be used in our day-to-day operations. This would fall under cash flow from operations, and since the cash went out of the business to purchase these ingredients, it will be cash outflow. This is how day 0 cash flow statement will look like. We had spent 5,000 on ingredients, so that will be negative 5,000. So total CFO will be negative 5,000. We had spent 10,000 and 20,000 on utensils and store respectively. Therefore CFI will be total negative 30,000. And also when business received 25,000 from bank and 25,000 from the owner, this will be inflow to the business, so CFF will be positive 50,000. If we add this CFO plus CFI plus CFF, we will get net cash flow of 15,000. Please note that this 15,000 will match with the cash item on a balance sheet. Now that we have understood the cash flow statement, let's understand the profit and loss statement. So technically, the profit and loss statement summarizes both the revenues your business has earned and the expenses it incurred during the specific period of the time. Typically, the P&L statement is divided into three parts. First is revenue. It is nothing but the earnings generated by business by selling its products and services. Second is expenses. So from the earnings, you have to remove the expenses which you have incurred as a part of daily operations. And last is profit. So it is nothing but the revenue minus expenses. This is the golden equation of profit and loss statement. Revenue minus expenses gives you the profit. Since this is the day 0 and we have not started our operations yet, so our revenue will be 0, and since revenue is 0, the expenses will also be 0. So the profit for our day 0 would be 0. These are the three financial statements of day 0. I had told you that the net cash flow at the end of day 0 was 15,000. This cash flow will flow to the cash item in the balance sheet and it will be 15,000. In this video, I had explained what day 0 cash flow statement and profit and loss statement would look like. In next videos, I will start a business operations and then explain how would these operations impact all the three financial statements. Until then, have a great life. Thank you.